Well, we may as well get started now, given it's a couple past the starting date, starting time. I'm Scott, your host of Brick by Brick, for those that are new or those that are viewing us on YouTube at a later date. Today, I'm joined by Juli Ann from Revesco. Revesco are reasonably new to the Parvis platform, and it will be really interesting to hear what they've got to say. It's a very interesting product. It's our first product with US exposure and our first product with, I guess, the open air shopping malls, as you call them on this side of the country or this side of the world. Yeah, very interesting. Keen to hear more about what you've got to say and learn more about Revesco myself. A little bit about today's webinar. Quick disclaimer. So the content today is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. You would have all seen a longer disclaimer elsewhere, so I'll save you the rest. About Parvis specifically, quickly, we're a technology-driven real estate investing platform and exempt market dealer registered in all provinces. What we do is bring institutional quality real estate investment opportunities to eligible and accredited investors across Canada, and we make that process as simple and easy as possible. More information on our website there, and you'll all receive an email or two after this, no doubt, from myself and the team. So I'll pass it off to Juli Ann now to get started. If you've got any questions, you can raise your hand or just throw them in the question Q&A or chat. Keep this interactive if you've got them. But yeah, looking forward to hearing what you've got to say here, Juli Ann. And thanks for coming on. So it's nice of you to make the time for us.
Great. Thank you so much. I just need to get control of the screen here. Sorry, 1 second. You'd think after all these years of working remotely, be a little bit better at doing this. Oh, look at that little teaser right there for everybody. Okay, full screen. Here we go. Thanks again for having me on today to talk about Revesco Properties Trust. As Scott mentioned, I'm Juli Ann Booker. I'm the Vice President of Strategy and Operations for Revesco Properties Trust. And I've been with Revesco for about a year. Just over a year, but I'm not new to commercial real estate. Previous to that, I spent a very long time, many wonderful years at Western Wealth Capital, and then I did a stint at JLL as their head of Canadian operations for JLL Canada. We are super proud to be working with you and your team, Scott. It's been absolutely wonderful. Love leveraging technology anytime to make investing easier and with still having the same oversight and compliance. It's really, really great. So I also have a disclosure, very similar to Scott's. This is all the legalese. This is not intended to help you make a decision. This is for educational and informational purposes only. So let's start. Who are we? Well, Revesco Properties Trust is just about nearing its 3rd birthday, but the Revesco story is actually a dozen or so years old. It started with Chris, Scott, and Reese, as we call them, the 3 amigos. These 3 young men, yeah, I had to say that, they made me, they actually went to university together and have remained friends all of that time. Mark Miles, our Chief Financial Officer, joined Revesco about 6 years ago and more recently became a partner. And that was after his tenure as partner at Dean's Knight in Vancouver, but he's moved down to Denver now. So Reese and Mark, along with our operations team, our property management, asset management, finance, all of that good stuff, are all located at our head office in Denver, Colorado. And Chris, Scott, and I, and a few other finance team members are up in Vancouver, Canada. So RPT is really a Chris and Scott story. And the reason I say that is because they are the biggest retail real estate geeks out there. And I know that sounds kind of ridiculous. Like, how can you be a geek about retail real estate? Well, I'm turning into one. but they actually started a tenant rep business, a brokerage firm called Northwest Atlantic in the mid-90s. So they've been business partners for about 30 years. They grew that business to about 50 brokers. They brought over 75 retailers from the US to Canada. So if you've ever shopped at a Costco or Walmart or Whole Foods, Apple, the list goes on and on. Somebody from Northwest Atlantic would have done that deal in Canada. So really deep knowledge of the retail industry, but put a pin in that. We'll talk about why that's really important later on. So
what good piece. Sorry, that's a good piece of information. I didn't know that at all.
It's really cool. And that's really the secret sauce. So I don't want to give it all away. We got to have a cliffhanger here, Scott.
Okay, sorry, I'll go back on mute. I'll leave it to it.
You know, all of this rehearsal. So what do we buy? As Scott said, we buy open air retail. So anything that doesn't have the traditional enclosed mall story to it. And there's a couple reasons for that. Enclosed malls generally are really based on fashion, apparel, beauty. These are more sort of luxuries than they are basic needs. Furthermore, you have to, as soon as you put a roof over it, you have to heat it, you have to secure it, and you have to maintain it. That all hits the bottom line of the investment. So open air retail is really great because it's triple net leasing, all the costs pass through to the tenant, and we get to manage these wonderful buildings, which a lot of retailers are going to as well. So when you think about where you live, I always say to people, think about where you live. Think about the best place to go on a Saturday. You're going to go where there's the Walmart, the Costco, the Home Depot, the pharmacy, and the liquor store, right? Maybe you're getting your hair done nearby. There's a gym, or you drop your kids off at dance or taekwondo if you're me, and you could just do everything in one spot. It's all about convenience. Retail is not dead. We will talk about that a little bit later too, but bricks and mortar is alive and well. If COVID taught us one thing, it's that people actually really like seeing, touching, feeling what they buy, especially what they're putting in their bodies and on their bodies. Retail isn't just fashion and apparel. Retail is a bank, it's a grocery store, it's restaurants, it's coffee shops. That all falls under the umbrella of retail. So we're always looking at the basic fundamentals of commercial real estate, which is you want to buy in locations with growing populations, growing jobs, where incomes are getting higher, where lots of people are flocking to. People go where jobs grow, right? Where those jobs are getting better, those wages are getting higher. That's just good for retail, which means it's good for us as owners. But when you dig a little bit deeper, there's a few other things that we really look for on our long laundry list of due diligence. First one is they have to be cash flowing. The trust distributes a 6% preferred return annually, and we do that quarterly. In order for us to even look at a property or really dive deeper into the rent roll, the first back of the napkin pro forma has to be able to sustain that 6% throughout its repositioning. So that's really important. These properties are cash flowing. We're also buying them below replacement cost. Everything has got more expensive in construction. That hasn't changed in Canada. That hasn't changed in the US. So not a lot is being built. And to add to that stuff that is being built, the rents are so high that retailers will prefer to go to a good center that's well anchored, just to have a little bit more flexibility in the rent. And then we talk about highly credited anchor tenants. So we're not going to buy a store or a mall that's anchored by just a dollar store. or something like that, right? We're looking for grocery anchored or shadow anchored. We're looking for targets. We're looking for big names that can really help us work our magic in the value add program. And this is where Chris and Scott really come in. So a few parts of our value add program. Obviously, the first one is leasing vacant space. We want to have high occupancy. We don't want occupancy to be so high that we don't have room to move rents. That's really important. Another fun fact is that in the United States, when you're buying a retail property, you don't pay for the vacant space. Now, you don't get to have a mortgage. When you're doing your lending, your mortgage doesn't take that vacant space into consideration. But it means that with the leasing background that our team has, we can have these spaces leased before we even get the keys, which has happened before. We also restructure leases. As I said, Chris and Scott have been in the business for a long time. Some of these leases of big stores are quite long. And as they say, we wrote lots of these clauses, so we know how to unwind them. So putting in incremental rent bumps, shorter leases for smaller shop space, longer leases for bigger tenants, things like that. Increasing density is also part of the plan, which is a nice bonus. Often you'll see these standalone pads, so where you would see a bank or a drive-through coffee shop or something like that. We can build that because, yes, we have a development arm at Revesco. So we have that in-house expertise should we need to draw on it, and that can increase the NOI. And then, of course, improving the tenant mix. We have a list of tenants in line that we know we'd want to replace current tenants with. And that's just good business. That's just making sure that should somebody leave, should something happen, you have seen retailers go out of business. We think that the ones that we have are quite strong now, but just in case, you always have to have a backup plan. And Revesco, we have plan B, C, D, E, F, etc. So how do we do it? Chris and Scott are the secret sauce here. As I mentioned, they had a brokerage firm called Northwest Atlantic, more than 30 years in retail real estate. That's literally all they've ever done. Why is this so important? This is important because the people that placed these stores in Canada that work for Costco or Target or whoever we're talking about also handle the real estate in the US. That means that at any time, Chris or Scott can pick up the phone and call the head of real estate at Staples or Winners, TJ Maxx, and any of these places and say, we're looking at a building. How does this one perform? Are you moving? How's the center overall? It gives us unparalleled access to tenant information, which is really what you need. Over and above the rent roll, we can get information that is really a lot deeper than just what you would generally see out there. So they're our secret. Well, the secret's out now, I think, but.
All right, I waited.
Does that make sense? That
Definitely.
Sort of like they're in a special club.
Seems like it.
Yeah. We also believe in doing things differently. We have seen a lot of people upside down. Commercial real estate had a really tough year that last year in Canada and in the US. We are buying only in the US simply because there's more of everything down there. There's more people, there's more centers, there's more retailers, and there's a few reasons for that. A couple of other things we do differently. So I mentioned that we can get this tenant information. We also have no variable rate debt, which has put us in a really strong position managing these assets through, times where there's interest rates going up and cap rates spreading. Because of this.
So that's a really important point, I think, that, me personally, I'll be sharing that with our audience for sure. I think that it's a question that we get a little bit of is when people do dig under the hood, what does it actually look like? So that's really good that you've shared that.
Yeah, it's really important, and I think it's really important, and I, as in my last year, I've pushed that point a lot, because a lot of people had done these mortgages in commercial real estate at ridiculously low rates. We're talking, it's a 2% coupon that they're paying on these assets. Well, that's a variable rate mortgage, and now that's a 7% coupon. So if you think about that, you just can't make the deal work anymore. You're upside down on with your lender, likely. We're seeing a lot of keys starting to go back. We're probably going to see more. You hate to see it, but it has positioned us. It put us in a position where we didn't have to buy anything last year when it wasn't a great market, because we knew that we had it covered. So we didn't have to buy a problem. And now we're set and ready to pick up some really wonderful assets in the next 12 to 18 months.
Brilliant, brilliant. We actually have a question.
Yeah.
The question is, what's your anticipation of the US economy and how it relates to the consumer?
Oh, that's interesting. I wish I had a crystal ball. I do not. However, one thing I know about the US and Americans, and I have a lot of dear friends down there, seeing as they're all my colleagues, is that Americans consume, the US consumer consumes even when they shouldn't. They don't stop. So
yeah.
Part of that, there's a couple reasons actually, is it's pushed. They're not as, Canadians were very careful about everything, right? We like everything to be ticked and tied really nicely in a bow. We save for a rainy day, that sort of thing. Down there, it's land of the free, home of the brave, and you just go. The other part is that when we're here in Canada and we're paying sales tax, when you go grocery shopping or buy shoes, whatever that is, that's either going to your provincial government or your federal government. In the US, that actually stays in the city or even the county. So the governments, the municipal governments have a lot of reason to keep people buying. So we're not really concerned about it at all.
No, there's definitely a cultural difference, a huge cultural difference.
Yeah.
In the way consumers consume, and
Yeah.
the attitude towards it within the country broadly. I mean, one of the biggest pieces you hear is US consumer this, US consumer that, and it's very, very rare that they slow down.
It's true. And then you add to that, people still need to go grocery shopping. People still, need to pick up their prescriptions, or just think of your everyday needs. That's what we're focused on, right? We're not buying centers where there's a Prada and a Gucci and a Michael Kors store, right? We're buying Costco, Walmart, Dollar Tree, Five Below, things like that, where you can just go get what you need. That won't stop.
If anything, those types of locations do better.
They do, because that high spending, right? People maybe don't go on vacation anymore, but they'll go out for dinner instead, right? There's always a trade-off. And that's something that we look at very closely in the cities, the sub-markets, right? We go really micro on these things. And then, right down to the retailers that we're putting in our buildings.
Brilliant. Thank you. We've got another question about the longer term plans in 5 or 10 years, but I assume you'll get to that.
We will get to that.
All right, let's leave it till then.
It starts with a 1 billion. We'll get to that. So no variable rate debt in the portfolio, which is great. We know exactly what our mortgage payments are. We can sleep well at night. And our long-term debt strategy, our CFO, Mark Miles, is very, very good on the debt side. And our goal is to have no more than 15% of our debt renewing in any 1 year. So as we grow and scale, that's something we are taking into consideration. Right now, we don't have a mortgage that rolls or comes up for refinance until 2027. Again, we're sleeping pretty well, because we think by then the new normal will have come into play, and we're not going to be having to renew at these really inflated interest rates. We're already starting to see them normalize. So let's talk about the actual fund. Like I said, 3 years, we're just heading to the 3rd birthday of Revesco Properties Trust, but Revesco itself, the sponsor, has been doing this for a long time. This is just the retail side of things. So for 12 years, we have exited 14 assets. We've transacted over $600 million in retail real estate transactions, and our weighted average annualized return across those sales has been 19%, just a little bit above 19 actually, but I err on the side of caution because I'm a Canadian. That is just to say that we think that we know what we're doing, or we know what we're doing. We've done it before. So although the fund hasn't cycled through anything because they're all really new properties in the last 2 years, Revesco itself has managed and done these assets before. And even more importantly than that, I think then the returns are the fact that the same investors that were with us 12 years ago are now investors in the fund. It's a pretty cool story.
Yeah, that's nice.
So the portfolio of Revesco Properties Trust right now is just over 400,000 square feet. We've got $100 million in assets under management. We're 99% occupied, 50% loan to value. We are very, very, again, well positioned with our debt strategy. We've got a lot of equity in these buildings. Nice average mortgage rate, nothing rolling till 2027, and a 4-year weighted average lease term, or WALT. For those of you who don't know what that is, and that's probably most of you, which is totally cool. Weighted average lease term is when you look at a shopping center, what is the average length of a lease? So you want it high enough that, again, you sleep well at night because you've got good recurring revenue and your rents are coming in. But if all of a sudden we're going to buy a building and the WALT is 10 years, well, now we know that we don't have the ability to move rents. We can't work that magic and increase that value. So WALT is a very delicate balance for us to make sure we're constantly adding value, but also giving us, enough time to keep working these new leases. The fund itself is open to registered investments or cash. You can invest in Canadian or US dollars. We are targeting a 12 to 15% annualized return as we cycle through these assets. As I said, they had done a weighted average of 19% before. We're doing a 6% distribution per year. The 4.75 to 6 is just dependent on the fee structure of the series that you come into, and that's because things need to be paid, like for compliance and things like that. So that's all factored in, and we can talk about that one-on-one later if you have any questions. Minimum subscription is 15,000 Canadian. All registered accounts are available for use. And the carried interest is 25% to the general partner over a 7% compounding hurdle rate, but only after surpassing the high water mark. So if we hit a 10% return this year and next year we only hit 7, then we don't get our carried interest. So that is really performance-based, which again, really aligns with our investors. The sponsors, so the 4 partners, have 10% of their money accounts for all the equity. So right now we're at about $50 million in equity in the fund. They're just about 5 million of that. I think that's really important for alignment when your sponsor's money is right beside yours. We talk about generational wealth a lot. These, we're looking at, these are long-term assets. We want long-term investors. We want people that are thinking about their future, their kids' future, and getting a nice return as you go through that. We also have a DRIP program available, which is reinvestment. So that's just those highlights again for you to see. We already talked about that. So far in our series, our F series, which is our lowest fee series, for the first 2 full years, we've seen just about a 15.5% total return. So we've come out of that J curve. We held pretty flat with our NAV last year because we didn't see anything trade. So we didn't want to push the values of our properties up. We even went against some of our appraisers that gave us some higher valuations because we were like, we don't have any data to back that up. And that's really important to us. We're prudent when it comes to your money, and it's because it's our money's right there as well. So why open air retail? I'm surprised nobody has asked me the question, well, what about Amazon? Everybody shops online now. Guess what? They don't. We will always say, even Chris and Scott will say, don't buy toilet paper and paper towel and things like that at a store. Order that from Amazon. That makes sense. During COVID, we saw at the height of the pandemic, about 18% of all retail sales in the US were done online. That was at the height of the pandemic. Now, that has normalized to about 15%. We might see it fluctuate a little bit, but it was 15% before the pandemic. We've seen it come back down. Like I said, people still like to see, touch, and feel. What is really great about retail right now, and why you might even start to see articles about the retail commercial real estate coming and being, for lack of a better term, I always say it was the redheaded stepchild of commercial real estate. It's really hard to understand. They're hard to manage unless it's your specialty. But now people are seeing it. It hasn't been built. It was way overbuilt. Now there's not enough of it. So we have historically low vacancy. Throughout the 2010s, it was around 8 to 10% vacancy was pretty normal throughout really the career that Chris and Scott have had. Right now it's 4.5. Well, that was at December 31st of last year. I think it's closer to 4.2 now. So vacancy going down, which means rents go up. Supply and demand is a big thing. It's just not being built. There's either not space for it or it's too expensive to build. You can't get the rents. We're seeing lots of absorption. One of the big questions I do get asked a lot is, what about, when Bed Bath & Beyond, for instance, went out of business, just even in Canada, right? There was all these stores and it was all over the news, all of this vacancy. By the time those headlines came out, the majority of those stores were actually already leased. Same with the announcement, Victoria's Secret just closed, big spot at the corner of Georgia or Burrard and Robson in Vancouver. They had a huge location. Again, they're closing. That's the headline. That's all you see. What you don't know is that place already leased, right? So you can look at the headlines. We can read whatever we can from the headlines. I always encourage people just to ask the questions. We love talking about real estate. And I tell you, if Chris was on here, he would be going on a lot longer than I would. So you're lucky you have me. And the traditional malls are also going out of style. I'm not a huge fan of traditional malls, never have been. I don't like the lighting. Makes me feel claustrophobic. But a lot of places are now seeing the beauty in going to these open air retail centers. So traditional stores that you would see inside malls are now leaving and going to open air retail centers. So retail alive and well, people have to eat, all of that good stuff. It's just a really strong part of the commercial real estate sector right now. And for us, we see only opportunity. So there's a lot of funds that are selling their retail properties right now. Why is that? Because they'll have a fund that has office and multifamily and retail and some industrial. So industrial still, doing well, maintaining value. Multifamily struggling a little bit, sometimes a lot, depending. Office, obviously, that's a really terrible story. Valuations have dropped. The only thing of value in some of these funds is their retail real estate. So in order to keep from having to gate redemptions or to give some sort of return or distribution to their investors, they're having to sell retail properties. Our sweet spot is about 25 to $35 million. That's what we like. We're not seeing a lot of those right now, but what we are seeing is the $50 to $60 million grocery anchored assets, which you just never see come to market because they're gold mines. There's this Whole Foods right here. This is actually at our property in Flagstaff. It's the only piece that we don't own, and we're actually in negotiations right now trying to get this under contract. And we are in best and final today on about $150 million of retail assets. So the pipeline is strong. We're seeing great assets come to market that you wouldn't have seen a couple years ago.
Great. Yeah, it's an interesting point when you hear, the best assets are the ones that people have to liquidate in times of trouble at times.
Yeah, it is. There's a big REIT in the States called Kimco, and they're a retail REIT. They're even bigger than, say, RioCan or Smart Centers here in Canada.
Sure.
And we're seeing a lot of their product come out, and it's because their partners need to liquidate. So,
right.
Sad story for them, great story for us. That's why, we are pushing, we're always raising equity. We do closes every month for our B series, F series closes every quarter. But if you're thinking about investing, if you want to learn more, I'm all about people doing their due diligence, and we've been scrubbed up by the best of them. We're on the shelf with, including Parvis, CIBC Wood Gundy, Richardson Wealth, Haywood Wealth Management, Raintree, Integrated Equities, Access Capital. And each of these groups does their own set of due diligence. So we've been scrubbed pretty hard, top to bottom, but are always happy to answer questions. We want people to feel comfortable investing, and it's just a good time for retail.
Yeah, certainly seems like it. And I can definitely identify with the buying things in person versus online, because it's frustrating at the end of the day for a lot of things, especially if it's new. It's a frustrating thing to do.
It is. And most retailers now, I actually wrote a piece about it probably earlier or sort of mid last year about the omni-channel approach. So a lot of retailers now have physical stores and online presence. So we've seen direct to consumer, like Athleta. That's a big one that you see in Canada. They started as a direct to consumer online only. Now they have many stores. And that's because people want the option. Lululemon, there's another great one. While they've always had brick and mortar stores, the omni-channel approach is perfect, right? I could actually see Lululemon from my office window, which is scary and dangerous both at the same time. But you go in, they don't have your size, they order it right there for you. Get shipped to your house. It comes, it's the wrong color. You take it back the next day. The common denominator continues to be the store. And that was really a COVID story, right? You buy online, you pick up curbside, you buy online, you pick up in store. It just works.
For sure.
Yeah. So in a nutshell, wrap it all up. You've heard me talk for far too long. Why us? Well, there's not a lot of people that do what we do, especially up here in Canada. We have boots on the ground. Our head office is in Denver. That is by design. It's a hub for United Airlines. We can be at any of our properties same day, which is really important when you're being an active manager, which you have to be in this business. Qualified experience, we've been around a long time. By using registered funds, you have a tax efficient way to US real estate. So US real estate, often you will have to file a US tax return because you're having US source income. Our structure is set up so that we have a tax blocker. That means that the taxes are paid at that tax blocker level, and then everything else flows up to the investor. You're only dealing with your regular Canadian taxes. And you can use your US dollars or your Canadian dollars. You can reinvest, set it and forget it. 2% discount to NAV for every time you reinvest your distribution. So if you're using your registered funds, that's really easy. Just keep growing that. And that's all I have for you guys today.
Brilliant. What's, just to address that question from before, what's the vision, the longer term plan?
Sorry, I got all excited. I said long-term plan. We want to take this to $1 billion of assets under management within the next 5-7 years. At that point, there will be an event, whether it's that we go public, whether we sell it to a public REIT, but something will happen at $1 billion. Right now, we're at 100 million. If we get a few assets under management this year, then we're going to be in that 250 range, which is another milestone. So I'm taking the step to 250. That's where we start to get institutional partners that are interested in investing. We already have a lot of people. We talk to a lot of these larger institutions. They just need us to be a bit bigger before they start investing. But they like what we do, and that's the long-term plan with $1 billion.
One step at a time, and seems to be definitely going in the right direction. It's a really, as I said at the start, it's a really interesting product for Canadians. And yeah, the first on Parvis's shelf that's anything like this. So
yeah,
very
and
interesting.
If you're like most Canadians, you are overexposed to the Canadian consumer, the Canadian dollar, the Canadian market. So even if you're not a huge fan of retail and you want some US dollar exposure, you can think of it that way as well. But happy to talk and answer any questions that come up for those that aren't online today but are listening.
For sure. Yeah, if there's no other questions, no hands up or anything like that at the moment. So thank you very much, Juli Ann. Appreciate your time. It was really great to hear about Revesco and learn more about what you're doing. And I'll be sure to share this with our audience for sure. This is awesome.
Wonderful. Thanks for having me, Scott, and to you and your entire team.
Thank you very much. Thank you everyone here. Thank you everyone online. Catch you later.
Bye-bye.